and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Just given all of the crazy headlines that have come out and moved the market in such dramatic ways, up, down, left, right, I feel like there's been a lot of short-termism kind of embedded within market volatility. The only thing we really got, as a relief to, that April 2nd independent, tariff implementation was a 90-day pause. And even then, we knew that the best case scenario was a flat 10% tariff rate across all of the nations.
It is ridiculous to think that Apple can move all of their manufacturing back to the United States. It's also ridiculous to think that consumers are willing to pay the $3,000 to $5,000 estimates for an iPhone if they are built in the United States.
We kind of expected this because of the Secretary of Energy, Chris Wright. He's been going around promoting and saying that under this administration, there will be a nuclear renaissance. And this has been a full circle for us because we started the company about 4 years ago and went all in on nuclear. And we kind of predicted, I would say, or I predicted this type of shift because everyone keeps talking about net zero goals. Like, how are you going to reach that? How are all these countries going to reach that without nuclear? So that was kind of our thesis, and we're very happy with what the administration is doing right now.
We got 1 hour to go until the market close. Taking a look at the major averages. Now, if it was a month ago, and you had seen the headlines that we saw today, maybe stocks would be down a lot more.
Yeah.
But maybe people have been conditioned now a little bit by headlines from DC. Be that as it may, let's first check on the markets, then we'll talk through it. The Dow right now down about 155 points or so, about a third of 1%. The S&P 500 down almost 0.5%, and the Nasdaq is down 0.75 of 1%. In all three cases, we have seen stocks gap lower at the open and then pair those declines as the day has gone on.
Yeah, it's a President Trump kind of day. Let's call it what it is. I mean, he's making headlines. He's dominating the headlines. He woke up feisty. It's new tariff threats. He's going after Apple. He's going after the EU. Now, what's going to happen here? Will anything come of this? I don't know, Julie. You don't know. But it did send the market down. I mean, the SPX, S&P 500, we were down about 1% at one point, right? What's interesting is, and then as the day goes on, we heard from others, here comes Treasury Secretary Scott Bessent, right? Now he's making comments too. He gives interviews. He does play this kind of good cop role, and the markets often like what he has to say. So he's giving interviews to the press today, and he's saying things that maybe they kind of like. He's, hey, listen, several trade deals, they could be struck in coming weeks, right? Bottom line, we're down, but well off the lows here.
Well, and then you also had then President Trump coming back out again and sort of re-emphasizing.
Oh, dug at his heels, totally,
But as we know, the most dramatic threats have not come to fruition. So do either the markets or his counterparties in this these negotiations, are they taking him seriously? I guess we'll see. But taking a look at some of the other assets that we are watching here today, or specifics here, Apple, of course, as we talked about in the crosshairs, we're going to dig more into that in a minute, but it is down about 3% today, seeing a mixed picture elsewhere. I do want to mention what we're seeing in terms of sectors. Utilities up 1.2%. That nuclear executive order being signed, giving a boost to some of those names today, even as tech is down the most. And then circling back around, there is one asset class where we have seen a little bit more reaction to some of the heat up in the rhetoric, and that is the US dollar, which down on the day, not seeing any recovery there. This is the dollar versus a basket of currencies. And I just want to take a look at a 2-year chart here because we are seeing the dollar at the lowest. Actually, let's take it out to 3-year. We're seeing it the lowest that we've seen since around December of 2023. So there we are seeing that weakness. Hold on.
How about yield? If any other day this week, that would have been our focus. Treasury, the 10-year, there you go, back above 4 or 5.
Yeah.
You know what? Let's get to the story of the day, though.
Let's talk about it. President Trump is back on the tariff offensive, threatening to impose a 50% tariff on the European Union and taking questions in the Oval Office about it.
I'm not looking for a deal. I mean, we've set the deal. It's at 50%. But again, there is no tariff if they build their plant here.
And that's talking specifically about Apple. I want to bring in Yahoo Finance Washington correspondent Ben Worschkel now to talk about what we just heard. Well, I guess what we heard earlier from the president and then what we just heard from the president, Ben.
Yeah, we heard a lot from the president today on this. It's sort of been a lot of focus here in Washington on taxes for a few days, but we're back. We're definitely back on tariffs. And that came in 2 social media posts from Trump that happened about 20 minutes apart. On the European Union, you saw some of those comments from Trump there, and he did underline that he is looking to do this. The deadline of this also has gotten a lot of attention, which is June 1st, which is in just a week's time. And this is a straight 50% tariff on the European Union that he says he's looking to impose. His comments this afternoon did double down on it, as you mentioned, but he also, I would argue, gave some glimmers of what might be on negotiations over the next week. He talked about things like lawsuits against U.S. companies. The digital service tax has always been a big issue for Trump in terms of whether that could sort of alleviate some of these tariffs. He also did directly say delays could be in the offing depending on whether companies are looking to move to the United States from Europe as part of this. So there are avenues of this. Secretary Besson also talked about how this move today might be about lighting a fire under the EU, is how he put it. So there's definitely levels of negotiations that Trump is clearly aiming to set off here. But again, this is a deadline that's just in a couple days. And the global reaction here has been real shock, especially at this 50% level. That's higher than most people thought he was even thinking about. It's higher than I would note we have on China at the moment. So this would, if this goes forward, this would be a tariff level higher than we have on our chief adversary. Europe is a close ally on a lot of fronts. And so the global reaction has been there. And it comes after a week where there has been optimistic chatter on tariffs that obviously all reversed today.
Can I ask you, Ben, Trump talks about a deal with the EU and he wants a good deal.
Yeah.
Do we know what a good deal might look like for Trump?
Yeah, I think we do have some glimmers of that with the UK deal that we had a couple weeks ago. There's certain areas where Trump is willing to move, others where he's not. I think any sort of purchases, clearly I think that's going to be a big part of the conversation. I do think a lot of these EU laws that really do get under Trump's skin, the digital service tax that does impact US tech companies, is something he's long railed against, and it is a kind of way to change things without getting at some of the deeper issues between Europe and the United States, like value-added taxes, which is another issue on the table that's a lot harder to change. It's a lot easier to sort of let up some lawsuits on tech companies than do this. So there's elements here of what it's going to be, but again, this is clearly an attempt to kind of make a lot of negotiations happen in a hurry, and so we have about 1 week to kind of see how it pans out in the immediate term.
All right, Ben, I know you were busy today. Plenty of headlines. Thank you, sir. Appreciate it.
Thanks much.
President Trump threatening tech giant Apple with 25% duties on overseas-made iPhones. Trump saying on a Truth Social post that he expects Apple's iPhones to, quote, be manufactured and built in the United States, not India or anyplace else. But it's now only Apple that faces this tariff threat. The president sharing further details in a press conference earlier this afternoon.
It would be more. It would be also Samsung and anybody that makes that product. Otherwise, it wouldn't be fair. So anybody that makes that product, and that'll start on, I guess, the end of June. It'll come out. I think we have that appropriately done by the end of June. So if they make that product. Now, again, when they build their plant here, there's no tariff. So they're going to be building plants here. But I had an understanding with him that he wouldn't be doing this. He said he's going to India to build plants. I said, that's okay to go to India, but you're not going to sell into here without tariffs.
Well, here with more now is Cory Johnson, Epistrophy Capital Research Chief Market Strategist and host of the Drill Down podcast. Cory, my friend, always great to see you. So let's just dig right into this news, Cory. So Trump going right after Apple. He's threatening Apple with this 25% levy if they don't move iPhone manufacturing here to the United States. You saw that headline, Cory. Give us your take. What did you make of it?
Well, you guys have covered this quite well. I mean, the notion that it's as easy as putting up a factory and building it here just isn't the truth. It's not how it works. But I spent a lot of time today working on let's work through some of these ideas and why does it cost? Why, there's been all this speculation, maybe a $3,500, $4,000 iPhone. Do you want an Indian or Chinese iPhone that costs $1,000 or the same thing in the US that would cost $4,000? And what would it look like? What would it take to do that? And the biggest reason obviously is labor. A Chinese worker might make $4 to $5 an hour. An Indian worker might make $4 an hour. A U.S. worker is going to make $20 to $30 an hour. At least that's what they make in a factory job right now, to forget the highly skilled jobs that would be required. We also don't have a workforce that's been trained to do these things, whereas the workforce is in China, well, even India. So Apple's been working with Foxconn to develop an ecosystem since 2017 to build phones in India. They're just expanding that, responding to the tariff regime, but maybe not responding at the speed of a tweet.
Well, and I guess then the question becomes, Cory, it's Julie, it's good to see you. What Apple does about this, right? Because Tim Cook has been trying to, I won't use the words cozy up, but he's certainly tried to make nice with President Trump in various ways. He has talked about...
Yeah, you mean the $1 million contribution to the inauguration committee like that?
Well, and the pledges of future manufacturing in the U.S., right? So, but that obviously hasn't done the trick. So, I mean, what does do the trick in this case?
Who knows? I mean, this does seem to be a policy on a whim. I've been chatting today with conservative friends who support President Trump, trying to see their take on this. And the instant response I got was jobs, jobs, jobs. We want jobs. And I pressed them kind of to think about that. Like, what does that look like? One of the reasons the iPhone is the cost that it is. I won't call something costs $1,000 cheap, although what it does is kind of amazing. But the reason the iPhone is so cheap is because the systems around it have been built for such a long time. The component supply chains that are built right around the factories where the devices are made. This requires long-term economic planning, both by government and by industry and by the supporting industries, right? The Foxconn plants that are built to build the devices from Apple. The semiconductor plants that are in a range surrounding these such that nothing is more than 50 miles apart or something. That takes a lot of planning and a lot of time. And so how does a company respond to these policy by tweet? And it might be to just kind of stall and to just kind of deal with it for a while, because the next administration of 4 years, whether it's Marco Rubio or J.D. Vance or fill in the blank of AOC or whatever you might imagine in our future as a president, is probably going to have some more long-term planning aspects to it, such that we don't have these kinds of shocks. And so maybe the companies just try to kick things that can down the road for a while.
There was another big headline this week, Cory, involving Apple, and I'm curious to get your take on it too, which is we had OpenAI buying Johnny Ives startup for a big price tag. And I'm curious, one, what you made of that headline, that news, and two, in your opinion, is that another worry for Apple investors?
I mean, competition is always a worry for any technology company because it comes on real quick. I mean, I don't think we should look at this as an acquisition. We should look at this as an acqui-hire, right? They wanted to get Johnny Ives, and they're willing to pay billions in cash and stock, and we don't know what that is. It looks like exactly to get him. It's kind of an amazing number, but it's going to result in sort of what the ultimate value and the ability to cash out that value is for Johnny Ives, right? If the company tanks and he's got $6 billion of once worthwhile stock, which is not going to be worth something in the future, it's not worth much. But Apple has spent over $180 billion by my count in the last 10 years on R&D, and I don't know what they've got for that, really. I mean, we know they spent a lot of money moving towards an automobile that they decided to walk away from, and maybe that was a good decision to not make it and follow good money with bad. But fundamentally, the greatest developments we've seen in technology in the last 5 or 10 years have not come from that $180 billion or so spent on R&D from Apple. And I think that that's a concern for that company to sort of see what the next big thing is. I mean, they've got terrific stuff and multi-billion-dollar businesses they don't get credit for, right? My watch, and I'm wearing my AirPods. You see they've got the CJ on there? I thought you guys maybe you can't really see it with the light. But in any case, they've done some incredible things. But I don't think that they've had the super incredible things like the invention of the iPhone or like the amazing things we've seen with ChatGPT or we've seen in other industries or even in the technology industry. And innovation in some ways, despite over $100 billion spent, has left them by the wayside.
Yeah, and Cory, so how should investors, do you think, be thinking about Apple at this point? I mean, in some ways, one could argue it has utility-like characteristics, right? Because it does have, you pay your phone bill every month, though you don't pay it directly to Apple, right? You pay the phone company that got the phones from Apple. But point being, it's sort of something that is baked into your life rather than this amazing transformative product?
Well, so the iPhone is amazing and transformative, and it's been around for a minute, so we tend to overlook the incredible things it can do and what's happening with the apps that make it more and more incredible day by day. But I think that from an investor standpoint, if you've got a company that's sitting on a Berkshire Hathaway-like pile of cash, but doesn't step into the market to do Berkshire-like acquisitions, and there's good reasons, maybe that's a good thing even, that they don't have that kind of dominance and monopolistic power that other companies like Meta and Alphabet have been charged with pursuing. But I think that, with that pile of cash, what are they going to do with it for investors? Can they step up buybacks to add to shareholder value? Can they increase dividends? Or I don't think acquisitions are really, giant acquisitions are open to them. And the company, in some ways, the balance sheet still looks like a reaction to the near-death experience of Apple from a generation or 2 generations ago, and maybe that's not necessary.
Maybe not. All right, Cory, thank you so much. It's great to see you as always.
It's good to see you guys.
Well, President Trump posting on Truth Social that he is recommending a straight 50% tariff on the European Union, and then telling reporters in the Oval Office that he is not looking for a deal with the EU. For more, we're bringing in Ryan Young, senior economist at the Competitive Enterprise Institute. Ryan, thank you for being here. So we get this posturing from President Trump, but as I was saying earlier, markets and perhaps his counterparties in these trade negotiations, I mean, how seriously should they be taking him, considering, he backed down from the reciprocal tariffs, he backed down from the China tariffs at the highest level. So how should we be thinking about this latest salvo?
Nobody knows. I don't think the administration even knows. The worry is that he might go through with this, especially since it's only on about 1 week's notice. And he did actually go through with 145% tariffs on China. Thank goodness that was temporary, but we're still at 30% when before, even in January, it was 10 to 20%. So even after the backing down, we still have higher tariffs overall. It's the same story with the reciprocal tariffs. And my guess is that while we won't get a 50% tariff against Europe, it'll still be much higher than it was just a few months ago. And that is bad news for the American economy and also for America's diplomatic relations around the world. We need allies against places like Russia and China, and threatening tariff wars is not the way to do that.
Yeah, there is this, I don't know if you saw this, Ryan, this term that the FT coined, the taco factor. Did you hear this one, Julie? The taco factor. Trump always chickens out. That's what they said, particularly with his trade taxes. I want to get your take, Ryan. I asked our colleague Ben Werschel this, but I'd love your insight too. I mean, Trump wants a deal with the EU. He wants a good deal. He wants a deal that looks like a win. And I'm curious, as you try to think through different scenarios, what could that look like, Ryan, in your opinion?
Well, Europe took a shot with reciprocal tariffs by using the word as it actually means. The trouble is when Trump uses the word reciprocal, he doesn't use that word by its common definition. Europe offered matching tariff declines along with what we were offering, and Trump said that's not enough, and he might have a point about Europe's competition policy, essentially using American tech companies as a piggy bank. But at the same time, threatening a 50% tariff is not the way to accomplish that objective. I mean, considering that the U.S. economy is shrinking right now, consumer sentiment is in the toilet, inflation is likely to go up next month, tariffs are causing far more harm than any possible good it could have to, say, the EU's competition policy.
Ryan, we're going to be talking to a market strategist a little bit later, and one of the things he said to us was that markets are overreacting to the tariffs because he says imports are only 10% of the U.S. economy when you look at the GDP calculation. Why is it a bigger deal than just that 10% import?
Because everything is connected. Roughly 60% of U.S. imports, it's not cheap plastic stuff like you find at the shelves at Walmart or at Dollar General. 60% of U.S. imports are intermediate goods. They are components, they are machinery, they are raw materials that American businesses use to make American products in America with American workers. So even if you have a product that has made in USA on it, maybe the machines that made it came from abroad. So anytime you have say, a 1/3 shipping decline from Asia, it's not just consumers that are getting hit, it's businesses as well. So yes, it's only 10% of GDP, but that 10% affects nearly all of GDP. Everything is interconnected.
Ryan, what do you make of kind of the bigger picture argument that you will hear Trump officials make, which is that, listen, they want to reform the global trading system. They want to put American firms on fairer, firmer ground. They think the trading system as it's configured now, it might have made sense after World War II. It doesn't make sense, they'll argue, in May 2025, that we impose a 2.5% tariff on auto imports from Europe, and EU hits back with a 10% import duty on us. What do you make of that argument? Do you think they have a point? And if so, how would you address it?
What they're doing is they're reasoning backwards. Trump just likes tariffs. That's it. Everything else that we're seeing is a rationalization of that. Just earlier today, Treasury Secretary Bessent was talking about how they're going to find the revenue maximizing rate for tariffs. Well, if you're using tariffs to strike a deal with Europe and then you back off that high rate, you get the deal, but you're not maximizing revenue. Or if you're trying to boost American industries, you keep imports out. If you keep imports out, you're not raising revenue either. All these rationales contradict each other. It's just people trying to rationalize President Trump's gut feeling that he just likes tariff. It's time for Congress to step in and stop him.
Ryan, thank you so much for your perspective. We appreciate it.
Thank you.
Well, the U.S. Justice Department has said it reached a deal with Boeing over avoiding prosecution over the company's 737 MAX crashes. Yahoo Finance's Alexis Keenan joining us now with more. So what does this agreement entail?
It entails wrapping up this whole ordeal for the resolution of the litigation that has gone on now since almost 2018, when the first Lion Air 737 MAX went down, followed by the Ethiopian Air MAX that went down in 2019, to settle the litigation that the Department of Justice has had against Boeing and the agreements that have been in place to defer a criminal trial. Because if you remember back now years ago, the DOJ had charged Boeing with the criminal felony of conspiring to defraud the U.S. government based on its representations of its employees to the government in the manufacturing and certification process of the 737 MAX. So this is a huge deal because it would resolve these claims that were reinstated after Boeing breached its prior agreements with the government to comply with what it wanted to do. Now, we don't know exactly what is in this agreement. It is agreement in principle. The DOJ and Boeing are telling the court right now, they say they're still working on finalizing it, but in talking with attorneys who are representing families of the victims of these crashes, as well as the victims' family members themselves. They have told me that on a call last week that they participated in with the government's lawyers, that there was a framework that was presented to them. And in this framework, there was Boeing coming up with an additional $444+ million that will be divided between the victims' families. Also a compliance improvements that Boeing will have to pay for, as well as a maximum fine under law that is possible to assess against Boeing, as well as an independent compliance consultant. Now, the victims that I talked to, they're not happy with this deal. They want to see Boeing stand the test of a trial. They say that previously, under the Biden administration, that Boeing had agreed to admit guilt to this crime that was alleged. They want to see this dispute publicly aired. They feel like they do not have transparency. And with a private deal like this, they feel like they're never going to get answers to why their family members died. Certainly, we would expect that this would be extremely beneficial for Boeing to be able to put this to bed.
All right, Alexis, thanks for reporting on this breaking situation. Appreciate it. We're just getting started here on Market Domination. Coming up, nuclear energy stocks soaring today as President Trump eases regulation and speeds up reactor development through a new executive order. We'll check in on some of our top trending tickers on the other side. Plus, Nvidia earnings will be top of mind for investors next week. We'll get you set with everything you need to watch out for from the chip giant later in the hour. Stick around, much more Market Domination still to come.
Stocks taking a hit today as negotiations with the EU have hit a snag. For more on what the latest trade wars mean for investors, let's welcome in here Jed Ellerbrook, Argent Capital Management Portfolio Manager. Jed, it's always good to see you. So let's walk through the trading day, Jed. It was a President Trump kind of day. He has dominated the headlines. He's going after Apple. He's going after the EU. The SPX, the S&P 500, it was down about 1%, Jed. Now we've backed off that. We're down about 0.5% here. As someone who actually has to put money to work, though, Jed, I'm just curious how you try to think through a day like this, think through headlines like this. How do you navigate it?
Yeah, good question. Patiently, I think. You're right. Tariff Man was back today. He'd taken a break for a few weeks. Last week, he took a trip through the Middle East and sold a bunch of Nvidia chips and Boeing airplanes. That was great. The market loved that. We'd like more of that. I think the market would be in good shape if we could stop talking about tariffs and talk more about the tax bill and have salesman Trump come out to help big U.S. business.
Well, I mean, we could do that if he would stop talking about the tariffs. We're just following his lead, aren't we, Jed? So, I mean, that said, stocks are not down that much today. Certainly not down as much as they were on earlier tariff announcements and rhetoric. So what do you think is the takeaway there? Is there sort of diminishing damage done from some of these announcements because the market doesn't take him seriously? Or is it just, we're going into a holiday weekend, there's not as much volume? I mean, what do you think is going on?
Yeah, I think for a couple weeks now, the market has been taking almost the most optimistic view possible of the tariff and trade war threat. Whether that's accurate or appropriate or not, we'll have to wait till, I don't know, another 45 days. We're about halfway through his original 90-day pause. But yeah, I think the market has been taking this all in stride, which is, I find it a little surprising, but I think that's been really consistent for a few weeks now. The market views these as negotiating tactics that will not be followed through on, despite the seemingly tough talk here this morning.
Against that backdrop, Jed, as I said, listen, you have to put money to work. You got to find opportunities. I'm interested in reviewing some of those. So let's give people some investment ideas. One name you like, United Rentals, Jed, ticker URI. Why is that one a buy, in your opinion?
Yeah, we've owned United Rentals for years, and we think it's an outstanding business. The kind of core reason we like it is because in America and most other developed countries, the users of construction equipment are gradually but consistently shifting from owning and maintaining the equipment themselves to renting it instead from the big rental yards like United Rentals and Sunbelt. So that is a kind of a steady, consistent boost to demand for United Rentals in its industry. And then on top of that, United is just a very well-managed company. They dominate the industry. They've got the most locations. So that means with these big mega projects going on around the United States, building semiconductor manufacturing, battery manufacturing, all the airport construction and hospital construction that you see when you drive around urban areas, those people want to use one contractor nationwide. And so United is the natural choice for big construction projects like that and the big contractors that serve them. So good business, consistent demand, and demand is hanging in there pretty well despite what seems like a kind of uncertain economic environment. The company hosted an investor event earlier this week and had mostly positive things to say. So it's a stock that we continue to like and have as a big position in our Argent large cap portfolio.
And then, Jed, let's talk about big cap tech and specifically the kind of AI related trade here, right? Nvidia is going to be a big event next week when we get earnings from that company. There was a report today that Oracle was dropping, something like $40 billion, according to the FT, on Nvidia chips for some of the OpenAI data centers. So it seems like the spigot is still on. What does that mean for investors?
Yeah, I think, so you're right. Nvidia earnings next week. We know about the bad news the company will report, the write down of the H20 inventory that was going to be directed toward China. The company's going to take a $5.5 billion write-off on that. They're going to lose future revenues that would have been tied to those products. So that's the negative that the company's already told us about. I think the guide for next quarter will be decent despite that, which is pretty impressive. And then I think the company's going to speak toward optimism looking further out. And that's mostly tied to what you mentioned, which is really a new class of customers for those accelerator chips. We're not just talking about, the hyperscalers, Amazon, Microsoft, Google, buying Nvidia chips to put into their cloud computing data centers. But we're talking about enterprise demand for Nvidia chips, and we're talking about sovereign AI, which is these foreign countries wanting data centers built in their countries filled with Nvidia chips. So I think that Nvidia still faces a really, really strong demand environment. They are more supply constrained than they are demand constrained.
Thanks, Jed. Appreciate it.
Have a good weekend.
Thanks, you too. Now time for some of today's trending tickers. We're checking in on shares of nuclear stocks as well as the latest earnings from Deckers Outdoor Corporation and Intuit. Shares of nuclear-powered companies first, and uranium miners for that matter, like Oklo on the nuclear side, Constellation Energy, NuScale Power, higher today as President Trump signs an executive order to ease regulations and speed up reactor development.
It's become it's become very safe, and tremendous work's been done on that, more than anything else, and it's really the automatic shutoffs. There's so many different things that they have now that they would have never had.
And you saw executives there in the Oval Office with him from the likes of Constellation Energy, which is the operator of the 3 Mile Island reactor. They're restarting another reactor under a contract with Microsoft. Oklo, which is a small modular nuclear reactor developer. Those don't exist yet in the United States, but that's one of the forward-looking technologies. And then you're seeing also the uranium miners rise in today's session. Those have been trending all day on Yahoo Finance as well.
Yeah, the big picture, just this attempt to kind of just ramp U.S. nuclear capacity, so speeding up construction, restarting shuttered plants and upgrading others. Trump talking about how nuclear technology, it's come a long way, he was saying, in safety, in costs. I mean, obviously the U.S. used to really be a leader in nuclear power, and now it's really China is your top builder. Bloomberg pointing out here they have roughly 30 reactors under construction over there because Russia also a key player as well. But you can see the move in some of these names.
Right, and just a couple of things to mention here. The reason that nuclear slowed in the U.S. was in part because of regulation, because it is extraordinarily costly and time-consuming to construct a new reactor.
And the permitting there.
Exactly.
Right.
And that's why the reactors that are being used currently in the United States are old, many of them. So that's thing one. Thing two, and the real catalyst behind this new push has been the rise of data centers and their just insatiable thirst for energy, but not only that, energy that is consistent energy. Nuclear is seen as renewable, right, to some degree. And so in contrast for these tech companies that do want to rely on renewable sources, in contrast to a solar or wind, which are not as consistent, nuclear does offer that kind of option if they can sort of fulfill the promise of getting this stuff up and running.
Yeah, I'm very interested to see more line of sight to research, because a big idea here seems to be, Julie, is like, okay, well, we're just going to cut through a bunch of red tape, right? So I'd be interested to see, like, okay, what does it actually mean on the ground? Like, before and after this EO,
right? How
much more quickly can you get a plant up?
Well, and are you sacrificing safety, which is always with nuclear a big concern?
One of the first questions.
Yeah.
All right, shares of Deckers Outdoor sinking today after the shoe company's quarterly outlook missed expectations, and it didn't give guidance for fiscal 26 due to uncertainties around global trade policies. So this one, under pressure, of course, owner of the Hoka running shoes, UGG boots. Q1 forecast disappoints, also declined to offer that full year guide. Dana Tesley over at longtime analyst we know who's covered this, did cut to market perform, target went to 120. She said Hoka growth decelerated faster than expected. She did point out UGGs was better than expected top line, but she did note this decision not to offer the guidance, lack of visibility around tariffs, and as we all know, what that means for consumer demand, just unclear.
Yeah, I mean, Hoka, you're still seeing it grow 10% in terms of its net sales, but it was growing in the higher double digits. UGG up 3.6% in terms of its sales, but the company now sees first quarter net sales of at most $910 million. The estimate was for about $923.5 million. So this had been sort of a growth name that now is looking like less so. For some reason, I'm picturing you in UGG boots. Do you have any UGG boots?
I don't, but I'm not opposed. I was, to your point, though, just looking at this stock really quickly and the kind of shelling it's taken. This stock is now down, we're down 50%. already in 2025.
Yeah, and it had been a big grower prior to that. All right, let's look at Intuit shares as well. Those shares are jumping today. They're actually at a record high. That's after the tax preparation software company reported third quarter results that beat expectations on the top and bottom lines. The company also reported stronger than expected guidance for the fourth quarter and raised its full year revenue forecast. The company has been trying to expand its services besides just the very basic tax preparation, and analysts saying that this quarter showed that there are some signs that that is working for them.
Yeah, RBC's Rishi Jaluria, friend of the show, of course, Julie, likes this name. Target is now $850. Rishi was telling his clients Intuit reported a solid quarter, strong tax season, says the Q3 results were solid. Overall outperformance, he said, was primarily from lower quality Credit Karma revenue, though he pointed out profitability came in ahead of consensus. Team at Evercore, also fans of this one, they tell clients continue to believe that Intuit's AI monetization opportunity underappreciated.
Yeah, I saw a couple of analysts mention that. One sort of question mark for the company is the future of the IRS's free preparation service, because that, even though Intuit doesn't make money itself from its free tax preparation, which it's required by law to offer, it had people trade up to the paid eventually, right? The IRS has been competing a little bit more with the free software, but this administration, there's some questions about whether that free offering from the IRS is going to stick around. So we'll see what ends up happening. That's something to watch going forward.
See how it shakes out.
Yeah.
All right, coming up, Nvidia earnings are going to be top of mind for investors, we know, next week. We're going to get you set with everything you need to watch out for from that chip giant later in the hour. Stick around, much more market domination still to come.
It's not long now until Nvidia reports its first quarter results. Investors will be all ears to hear what the chipmaker will have to say on sales amid China hurdles and hyperscaler spending plans. Here with a closer look, Matt Bryson, Wedbush Securities Managing Director. Matt, it's good to see you. So as we look to Nvidia next week, obviously there has been a lot of chatter around, in particular, its sales into China of the H20 chips, the more advanced chips, which have now been blocked. Where is Nvidia going to need to sort of show growth here? What are investors going to be watching as we see that potential shortfall?
Yeah, so with the quarter they're reporting, those H20 sales actually were running ahead of plan until we saw the government block them, I believe. And added to that, Nvidia had some problems with Blackwell heading into the quarter. I think those really got smoothed out as the quarter progressed. And so my sense is with Q1, those better pieces, the better sales into China, at least initially, better shipments of Blackwell, that's really going to offset any loss of China sales in that last month. Where there's some impact is on the guide. So generally it's thought that the China piece is maybe 10% of the data center revenue. So let's call it 4 billion-ish. I think their consensus is starting to take down estimates a little bit. But at the same time, with Blackwell getting better, with these new sovereign deals coming in, I think there's less concern moving forward than there was 2-3 weeks ago, because there's all these other new revenue sources that are popping up.
You know, to start the year, Matt, it was interesting that the stock was struggling. There's different reasons for that. One reason was DeepSeek, and NVIDIA executives addressed that. In your opinion, did they address that concern to your satisfaction, Matt? Do you think that concern is in the rearview mirror?
I certainly think it's in the rearview mirror, Josh. So if you look at what actually happened with DeepSeek, so predominantly a China phenomenon, DeepSeek was driving significantly more demand than expected for AI servers in China. And so I think at the end of the day, what you saw from DeepSeek was it was good news for NVIDIA. It was more demand. So I think that concern is certainly behind them.
Matt, one of the other reports related to NVIDIA that we got today came courtesy of the Financial Times, which said Oracle was planning to spend about $40 billion on NVIDIA's GB200 chips to power OpenAI's new data center. I don't know if this is a surprise, because if they were building the data center, it was likely they were going to get Nvidia's chips. But it does speak to the reliance of Nvidia on spending from the hyperscalers. So what can we expect in terms of cadence with that spending?
Yeah, so you saw earlier Crusoe also announce that they've secured funding to build out those facilities. So, and I think when you look at the news from the Financial Times, let's assume it's accurate, they're talking about GB200 chips. So the current generation of product, that tells you that's going to come earlier. Let's call it in the next 2, 3, 4 quarters. And so from a cadence perspective, Julie, I think if it doesn't show up in Q2 for Nvidia, it shows up in Q3, Q4, because when you get beyond Q4, you really start to see GB300, the next iteration of chip, becoming the larger portion of volume out of Nvidia.
Matt, another big question, of course, top of mind for NVIDIA investors was the AI boom and whether big tech would continue to invest so much in that boom. You heard those last earnings reports, Matt, from Meta and Microsoft and Alphabet, and when they talked about their CapEx guides, they remain confident. I'm just curious, when you look past 2025, Matt, you try to look in 2026, what do you see AI spending looking like from the hyperscalers?
Yeah, so it's hard to peg how much hyperscale growth there will be in 2026, and that's always kind of been the question, right? Can we continue to see the large clouds grow their spend like we've seen the last few years? The difference this time, I think, and I think your prior guest talked to this, we have all this incremental additional spend coming from these projects that are outside the hyperscalers. So in particular, the sovereign deals we've got, both Saudi Arabia and UAE, and remember that I believe it was the UAE number in terms of chips, that was larger than the amount of product that Oracle is supposedly buying. So these large deals are really additive, and I don't see the clouds stepping away. The last thing I'd add there is, so one of the concerns has simply been that applications aren't going to show up. I think when you see OpenAI go out and spend the significant amount of money they did on Johnny Ives' new startup, that tells you that there are edge products that are getting close to being ready. And I think those edge products are going to be AI driven. And again, at the end of the day, that ends up creating growth for AI silicon like NVIDIA produces.
Everything comes up NVIDIA, it seems, in that AI universe. Matt, thanks so much. I appreciate it, and have a great weekend.
You too. Thank you.
We have breaking news now to tell you about right out of Washington. A steel deal getting closer here. President Trump says he supports a partnership between United States Steel and Japanese company Nippon Steel. He stressed that the collaboration would keep the firm in the U.S., headquartered in Pittsburgh. Trump says the partnership would create at least 70,000 jobs and add $14 billion to the U.S. economy. And the Wall Street Journal has been reporting that Nippon Steel had been in discussions with the U.S. government, and Nippon had offered some of these concessions, right? Possibly building a plant in the United States and also doubling its spending plan here.
Yeah, I mean, initially, of course, Trump was not a fan of this takeover. And remember, Julie, I mean, this became a real issue on the campaign trail in Pennsylvania. And then he comes back into the White House and he made it clear, he wanted Nippon, okay, you need to start showing some investments in U.S. Steel. Right? He made that clear that was a priority, and they've promised to do that.
I'll be curious to hear as well what the steelmakers union has to say about this, because all along they have been resistant to this deal happening, even as U.S. Steel said, listen, if we don't get this deal, we might have to shut down. We certainly would have to cut back on jobs. So that'll be an interesting part of the equation to see what they have to say.
Yeah, we shall see. All right, big box stores, meanwhile, reporting quarterly earnings this week. And while it's been a mixed bag for retailers, some names are rising above the competition and the tariff landscape. We're navigating how to play the retail sector with the Yahoo Finance playbook. And joining us now is Brian Mulberry, Client Portfolio Manager at Zacks Investment Management. Brian, it is always great to see you. So let's compare and contrast some of the big names in this space, Brian, and get your take on how you kind of see them. One of the first ones would be the obvious one, Walmart and Target. Now, you might throw up those stock charts, Brian, and you can see how that kind of tells the story. We did recently this week, Brian, we had a Target bull on the show, and I think his argument was more valuation. He just thought a lot of the bad news had been priced into Target. I'm curious how you see it.
Yeah, I certainly understand the argument. I mean, Target's down close to 40% on a year-to-date basis. There is a point where the valuation starts to become a little bit more attractive, but for us, it has to start with some type of earnings growth, and we're just not seeing, at least in the near term, for Target. They're still continuing to struggle with some legacy issues from COVID in terms of getting their inventory timing down properly, and now you throw on top of that the issue that they still have around 30% of their goods directly sourced from China. So they're really struggling to get things right, to turn the corner and look better from an earnings growth. That profitability picture just isn't clear enough for us to like the name. On the other side, you've got Walmart. They've got a little bit more diversity in their product lineup, and that's showing in the sales growth that they have. You know, April retail sales, I think, came in as a surprise for all of us, and that just, it was positive. It was up 0.1%, but that's $721 billion out there for grabs for these big box retailers at this moment in time. And what we found in Walmart's earnings is their average ticket size is going up. So foot traffic is roughly flat, maybe slightly lower, but they're getting more wallet share from consumers, and that's the biggest difference between the two stocks right now. You have consistent revenue growth and consistent profit growth from Walmart, and Target is almost the other side of the coin, almost the complete opposite.
All right, we need a little like ding, ding, ding to talk about the second round here. So let's talk about two other retailers. So clearly you think Walmart has the advantage between Walmart and Target. What about Home Depot and Lowe's, two other retailers we heard from this week, and you know, taking a different approach in a number of different areas, including on tariffs?
Yeah, absolutely. And I mean, the news that we got from Home Depot is that here very soon, their overall exposure to China, and the reason we keep bringing up China is it's the worst case scenario, the maximum level of tariffs that we know about in this point in time coming out of China. That's where it impacts earnings over a long period of time. Home Depot says very quickly, we're going to have less than 10% exposure, and that adds a lot more durability to their long-term profit structure. Home Depot's also made a lot of investments linking customers to contractors getting jobs done. And in that retail sales number from April, building materials were up 0.8%. It was one of the bigger drivers in there. And so we saw that reflected in a little bit stronger, I think, than expected numbers from Home Depot coming out of Q1. And they're doing a really good job of managing that long-term profit structure, mitigating the cost of tariffs. And so it's a name that we like more than Lowe's for similar reasons. Lowe's has more of a DIY type of a feel. And unfortunately, the customers at this point don't want to do it themselves. They want to be connected to that pro segment. Now, Lowe's is growing there. It's one of the faster growing segments of their business, but they're just really far behind the curve when it comes to those types of projects. And Home Depot's really built a whole system around that pro experience for contractors and bulk orders, and also connecting them to consumers to get jobs done. So we're just finding the integration, and the money already spent on that growth is paying off for Home Depot.
And how would you characterize valuation, Brian? I mean, you must find it compelling here.
Yeah, absolutely. I mean, I think there's a really good story here. I mean, there's a lot of people out there that are going to be anchored to their properties because they have a 2 or 2.5%, 3% mortgage rate. So they're going to continue to stay with those properties, but want to improve them over time. So given the current valuation and the long-term revenue growth, this is a very strong company that has a commitment to returning capital to shareholders. And they also want to make sure that they're staying in line with that strong balance sheet directive that they've had over the last 3 years. It's really paying off well for them because they have low levels of debt. Lowe's, on the other hand, is very leveraged. They have a lot of debt on their balance sheet. And so, again, it's just in terms of where you're assessing risk versus reward over this period of time, Home Depot definitely seems more attractive.
All right, advantage Home Depot in that round. Round 3, we got TJX versus Kohl's. I don't know if this one's quite a fair fight, to be honest, Brian, but talk me through your thinking on these two.
Yeah, so, I mean, they're almost not even in the same ballpark.
Yeah.
If tariffs are your main concern, and we could understand why, TJ Maxx has a variety of ways to source inventory, and sometimes they can buy directly from unsold department stores' inventories that have already paid tariffs if there were any to begin with. So they have a way of getting goods on shelves that are in demand. We all love the name brands that you can find at TJ Maxx and Home Goods and pay obviously discount prices. There is a model there where TJ Maxx has some exposure to direct manufacturers that come from the Pacific Rim regions, and China being part of that, but they have a way to mitigate that through multiple levels of sourcing. Whereas Kohl's, again, they're still too dependent on China directly to get products on shelves. It's roughly 20 to 25% of anything that you find inside a Kohl's store is going to be subject to those maximum levels of tariffs right now. Again, just putting a lot of pressure on the near-term profit structure that is also weighing down long-term growth. So it really comes down to know what you own, know why you own it. And at this point, if you're just paying attention to some of those finer details, higher quality balance sheets are winning the day.
At the same time, Brian, you look at that Kohl's stock chart, and this stock has been shelled, Brian. I mean, how much, you obviously just don't think all the bad news is priced in there.
No, I think that they're just not getting things right in terms of sourcing and controlling costs at this moment in time. Unfortunately, I think there's more volatility to come because they just simply can't right the ship and turn a corner to profitability. They're having to continue to further discount goods, weighing on margins. Their average ticket sales is going down at this point in time, so they're having to find different ways to incentivize customers. Adding too many incentives means you're weighing on that profitability. So they can still have a certain amount of top line sales that keeps the business running, but they're still squeezing that overall profitability quarter after quarter after quarter. I don't think all the bad news is quite priced in just yet.
Brian, always great to see you. Appreciate your time and those picks, sir.
Have a great weekend.
You too. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.